My name is Riza and welcome to Lessons Learned from Prof. Sembel's Corporate Finance class.
Lessons learned, lessons learned, from corporate finance class.
Last week we talked about many things, but there are two particular things that I would like to discuss in this video. The first one is the context of corporate finance itself, and the second one is the time value of money. So let's talk about those things.
So takeaway number one from the context of corporate finance. So what is there to manage in corporate finance? More or less, there are 8 things to be managed. There is capital structure, or how to lower debt to equity ratio. There's working capital management, or how to choose the working capital financing. There's asset structure, how to reduce the fixed asset ratio. There's revenue management, how to create higher portion of the recurring revenue. There's cost management, how to lower the fixed cost portion. There's cash flow management, which focus on 5 principles of cash management. There's growth management, which focus on organic and partnership growth of the company. And there's also the risk management, or how to lower the risk appetite. Okay, second takeaway for the context is the entities and the dynamics between these entities and corporate finance. So as you can see, there's corporation, there's investors and government, and there's cash going around, there's securities, and there's taxes to the government and as well. The third takeaway is there are 4 cornerstones or 4 principles of how to create value in corporate finance. There's core of value principle, in which the combination between 3 things, the returns of capital, growth, and cash inflows, is what makes value created in corporate finance. And there's conservation of value principle, there's expectations treadmill principle, and there's also best owners principle, in which the principle stated that a business values depends upon its owner capabilities. So if the owners they don't have the capabilities to manage their assets well, they can ask another entity or another company to manage that. One of the way is by selling that asset to that other company who has better capability than them. The fourth takeaway, we learn about the time value of money, which is receiving $1 today is actually worth more than receiving $1 in the future, because of what it is called the opportunity cost, which is the interest that we could have earned if we have that $1 sooner or today. So if we have $1 today, that $1 will be translated into $1 plus interest in the future. So that's what makes $1 today worth more than in the future. So based on that concept, we learn about future value and present value. Future value, or compounding, is how much $1 today worth in the future, or future value. And vice versa, the other way around, $1 in the future could translate into different amount of dollar in the present value. Depends on the discounting rate, and for the future value, depends on the interest rate.
So that is the lessons learned from last week. I'll see you all again next week. Cheers!